Good morning, Alta Realty Group agents. This is Kevin Lauren, and today we're happy to have Adam Nishikawa with us. Good morning, Adam.
Good morning. Thank you.
Yeah, and we're also glad to also have our corporate broker Travis Breton with us as well. Travis, good morning.
Good morning. How's it going?
Very well. So today we're going to be, this webinar is about 1031 tax deferred exchanges, and so we've brought an expert along with us. So Adam, first of all, just give us a real brief background of who you are and your company, and then you can get into the meat of your presentation. And I'm sure we'll have questions along the way. Remember, everybody, we do have a chat feature, so if there's any questions as Adam is progressing, you can certainly use the chat feature, and I will try to facilitate that. So take it away, Adam.
Perfect. Sounds good. Well, thank you everyone for having me. Just wanted to go over a brief history of our company. You know, we were part of Chicago Title back when we were considered Safeco, and now we are an independent 1031 qualified intermediary. We're headquartered out of San Diego, but we have offices in Orange County, LA, and Northern California as well. Great. And we facilitate somewhere between 3,000 and 5,000 exchanges every year.
And is that in California, I'm sorry, or is that just in nationwide or?
I would consider that nationwide. However, you know, we do a lot of exchanges out of California just due to the increase in property values.
Got it.
Perfect. Well, I guess I'll dive right into it. Does that sound good, Kevin?
Yeah, for sure. I appreciate that, Adam.
Perfect. So I always like to start with a definition of what is a 1031 tax deferred exchange. And essentially,
that's a great place to start because we do have some new agents with us.
Let me go to the next slide. Let me make sure this is working.
Yeah, no problem.
Frozen. It's like I'll be clicking through it. Okay, perfect. So essentially, a 1031 exchange does come from Internal Revenue Code Section 1031, which is a section of the tax code. And this is the brief definition of what it means. It is a transaction which permits an investor to defer the payment of capital gains tax by exchanging investment property for like-kind investment property of equal or greater value. So this definition obviously has several parts. And the first part I like to break down is basically the deferment aspect of the 1031 exchange. This is not tax-free money. This is a deferral of tax. So the saying in our business is defer, 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 die, because your heirs get a step up in basis and your clients essentially never have to pay the taxes. So that's the first aspect I like to go over. Okay. Second aspect is definitely the like-kind part. What does like-kind mean? A lot of our investors think because they have an apartment complex or an apartment building or a condo that they can only exchange for another apartment complex or another condo. And essentially, they don't realize that the broad definition of like-kind is basically a qualified use of the property. So as long as it's used for investment purposes or business purposes, it qualifies for the 1031 exchange. Oh, wow, so we have clients, awesome. farmers out of Central Valley that basically they're done with farming. Their kids are millennials and they use cell phones and therefore they don't want to farm for the rest of their life, and they end up exchanging into a multifamily complex or something that's a little more less hard labor and more cash flow. And so there's really no limit as to what qualifies for the use of the property. Here are some examples. What could qualify as replacement property? So single family residential, multifamily, we've got all the commercial there, office, retail, industrial, oil and gas rights, mineral rights, water rights, air rights. If you have any clients coming out of New York and they have a 30+ year lease called a co-op there, that would actually qualify as real property, as well as the Delaware Statutory Trust, which I can briefly go over at the end. But all of these could potentially be qualified replacement property.
Awesome. I did not realize that, Adam. That's really cool.
So what does not qualify? This is equally as important. Primary residences, there is a way to combine a 121 exclusion with a 1031 exchange. Stocks. So unfortunately, stocks are personal property and not real property, and therefore they are not eligible for a 1031 exchange. And third, personal property. The only change they made to the tax code several years ago when Trump made all those major changes was essentially they eliminated personal property exchanges. We used to do highly appreciated artwork, planes, boats, things like that. Those are no longer exchangeable.
Got it.
So there's a few general requirements the government requires you to maintain. And essentially, the first one is holding title. So we are just a tax ID number to the government. So the same taxpayer who holds title to the relinquished property must be the same taxpayer who holds title to the replacement property. So essentially, if you sell in John Doe Corporation, you must buy in John Doe Corporation, etc. Some examples of vesting exceptions would be a revocable living trust, which is a disregarded entity, and a single member LLC. The reason this is disregarded is essentially because your single member LLC is still filed with your social security number and your tax ID number. And so essentially, if you go in and out of this LLC, so if you sell as John Doe, independently and then buy in a single member LLC, it's okay because it's the same tax ID number on both of those, both titles. And so that's because we're just a number to the government. They just want to see the same number across the board from the sale to the purchase.
That makes sense.
Hopefully that makes sense.
Yeah.
Next, we have one of the other very important general requirements, and that is replacing debt. So yes, the taxpayer must replace the value of the relinquished property debt and the equity with either a loan, cash, seller financing, or private money. So in this example, you have $1 million sale, $700,000 is coming out of that as equity. Your investor will essentially have to replace that $300,000 loan they had on the sale property, because that loan will have a payoff contingency, obviously. As soon as that home is sold, that loan will have to be paid off. But on the purchasing side, they will have to replace that loan. And there's several ways to do that, but those are the ones listed that we see most commonly. So if you decide to decrease the amount of loan, you would pay a taxable boot on that. And if you decide to decrease the equity, you would also pay a taxable boot on that. It's two separate taxes.
Got it.
So here's a snapshot of a potential tax liability. And this is what I show all of our clients because they need to understand, that this is what they're liable for if they do not do a 1031 exchange. So first, you'll have the federal capital gain tax at 20%. Next, you'll have the affordable healthcare surcharge at 3.8%. Third, you'll have depreciation recapture. This is going to be 25% of all depreciation taken over the lifetime of the asset, which means that if you've been depreciating this asset for the full 27 and a half years for a residential property, they would owe 25% of that benefit back to the government. And most people don't realize that that's a huge chunk, and they just think, oh, the capital gain tax is this amount, and it really can add up to be quite a lot, especially for lengthy landowners.
Yeah.
And of course, the state tax rate. So typically we see a potential tax liability between overall of the sale price to 38%. So it can be a very large chunk of that sale price for sure.
Mm-hmm.
Okay, so if you're entering a listing pitch session with an investor and you want to see what are the main points I should touch on, or at least be listening in their voice for why would this be a good program for them? So first, obviously, is deferring tax consequence. Teaming up with their CPA, being that person that's their most trusted advisor, listening to what their tax consequence is. Number one, that's going to be the hands down biggest reason people do a 1031 exchange. Usually you'll have a large number that will likely scare your clients, and so it's helping them understand they have another option. Second is increasing cash flow. So for a lot of our clients, especially long-time landlords, they have paid off properties, and that equity is actually not giving them a good cash-on-cash return. And what I mean by cash-on-cash return is if you have two buildings side by side, one property has a loan on it, and one property is paid off. But if they're identical buildings, they will be charging the same amount of rent, which means the person with the loan has more their money is working much harder for them from a cash on cash perspective. Whereas the person with the paid off property, they are limited on exactly how fast rents are raised for how much they can increase their cash flow. And so for a lot of those clients, especially here in California, they're getting a 1% to 2% cash on cash return, if not almost negative, due to the large amount of equity they have in their property, especially if they haven't been pushing rents in the past. So increasing cash flow, huge reason. Third, we have diversification and consolidation. So a lot of our clients, they're retired. Maybe they only have one property and they realize, hey, I only have one property, one tenant. If I lose that one tenant, I lose 100% of my cash flow. So for them, they want to diversify. They might want to sell that one property and go buy 2, 3, 4 properties so that when they lose a tenant, they only lose 25% of their cash flow. So this can be a huge reason people will look to do a 1031 exchange, especially if they're looking to diversify into other states or they want to try moving from a cash flow perspective into a appreciation perspective here on the coast. Also, the other way around, we have a consolidation. We have a client right now, he's selling 10 single family homes. He's 75 years old. He does not want to be managing 10 single family homes. So he's selling those and he's going to go purchase one multifamily property. That'll be easier for him to handle. He only has to hire one property manager. Still could be a lot of work, but at least it's not spread over 4 different zip codes. So from his perspective, he thinks it's more manageable. So consolidation, it works the other way around as well. The fourth reason here is relief from management. Basically, a lot of our older clients, they're just tired of being landlords and they're looking for what else is there. So for them, the relief from management perspective is huge because maybe they have a headache property and they want to move into something that might be a little bit easier, whether that's a semi-commercial, triple net, or maybe like a DST, a Delaware Statutory Trust, where you just get a check every month in their bank account. That's the end of that. They don't have to pay taxes.
They want the mailbox money, right?
Exactly. They just want to walk outside in their underwear and pick up their checks.
Exactly.
So relief from management one is huge. And then, of course, depreciation. If you have this is the lowest hanging fruit. If you have any landlords that have owned a property anywhere over 20 years, if it's residential property, they can only depreciate for 27 and a half years, which means basically they have to exchange out of it to get more depreciation, more tax write-offs. So from their perspective, as a future planning reference, not knowing where our economy is going to be in XYZ years is now a good time to exchange and take advantage of the appreciated property they currently own. So depreciation could be huge. And for those of you that want to know what commercial is, they can depreciate it for 39 years. So a little bit longer for commercial, but for residential, 27 and a half years. And last but not least, we have estate planning. I think estate planning is huge. This is one of the top reasons we've seen people do 1031 exchanges, especially if it's in a trust. One of our clients recently, he had 2 kids. They don't talk to each other. He knows that they're not going to talk to each other after he passes away. Unfortunately, he already has passed. But what he did was he sold that property and he bought 2 properties, one for each of his kids, left it in a separate revocable living trust. And there you go, voila. They don't have to talk to each other. They don't have to decide what to do with this property. They each have a property that they can use for whatever they want to do. One of them could liquidate, one of them could hold it.
Yeah, I would imagine this is the biggest one, of course. One of the biggest reasons that people use a 1031 exchange in the whole estate.
Exactly.
Avoid headaches, yes.
Yes, that's what we all want. So basically, the government gives you several options for how to facilitate this program. The first is the delayed exchange. This is the most common 1031 exchange. It's 90% of our transactions. It is a straightforward exchange. So on the timeline here, if you pay attention to where the 0 is, that's going to be the sale of their investment property. So it's listed just like it would any other property. I have trifolds, which I will be sending to Kevin in PDF form that have a contract addendum. Basically, you put that in the contract, just letting the buyer know you're doing a 1031 exchange. It does not affect the transaction in any other way. And basically, at the close of escrow, that's going to be the start of your time frame. So you'll list the property, just like any other property. You will, at the close of escrow, that money will get transferred to a qualified trust account at the bank where it would be completely separate from your investor. So a third party, that's hence the reason why we exist. And then you will have 45 days to identify what your clients want to purchase. So 45 days goes by very quickly. I mean, when it comes to finding property, especially when property is going off the market, 45 days can be rather quick.
Oh yeah,
So we
everybody
encourage
on this
you.
call knows that real well.
Yeah, exactly. So it's really important that you have that option to basically know what you're purchasing. Maybe it's already in contract. Maybe even before their property sold, they were out looking at properties and they found one and they got it under contract. So that as soon as their property sold, they were able to execute the 1031 exchange. You can change that list as many times as you want within 45 days. But at the 45th day, that list is finalized. So the government gives you three options. You'll have the three property rule. You can identify up to three properties regardless of fair market value. So that means you could sell for $1 million. You could identify $5 million of real estate. No issues. The 200% rule, however, is for your clients, you want to identify more than three properties. They cannot identify more than 200% of their sale price. So if they sell for $1 million, they can identify up to $2 million of real estate. Where this is important is where we have clients who come out of California, along the beach, maybe Newport Beach, for example, and they want to go to Arizona. Well, to go to Arizona, the properties from Newport Beach, you have to buy a lot of properties. So for a lot of them, they have to actually go out there and they have to scout out and create a list of 6, 7, 8 properties that they want to buy because they have so much cash. So the 200% rule would be right for that client. And then third, you'll have the 95% rule. If you do want to ignore the three property rule and the 200% rule, you must close escrow on 95% of all identified property. So for all intents and purposes, that's 100% of the property you identify.
Got it.
45 days is the crucial timeline. After the 45 days, you will have the remaining 135 days to close escrow on that property. So the full transaction takes place in 180 days. So really, the biggest thing is the 45-day time frame. If you need earnest money deposits to go into contract on any of these properties, we will wire that to closing escrow. But if say the sale hasn't closed yet and your clients have to come out of pocket with that earnest money deposit, that's okay too. They will be reimbursed for that amount when we conclude the transaction. So if they do need to do that, that is an option. So next we have the reverse exchange. Basically, this is complete flip of the delayed exchange. This is if opportunity knocks, inventory is low, your clients don't want to take the 45-day risk, and they want to purchase the replacement property first. Your clients will actually be able to purchase the property before they sell their other property. So they know exactly what they're getting. They know that it's the property they wanted. They weren't on a deadline to find the property. They were looking for as long as they wanted. The deadline does not begin until after they purchase the property. So in this timeline, what happens is they're going to purchase their property. That's where the 0 is. The close of escrow on their purchase of their property will trigger the 45-day timeline. During that 45 days, you must identify what you want to sell. So obviously, for many reasons, this is much easier. The investor knows which property they want to sell. And then they have to sell that property in 180 days, which under the current economic climate has been very doable. So basically, this transaction takes place just flipped completely from the delayed exchange. I do want to go over a couple of the issues we have with this type of a 1031 exchange. The first is the government does not allow you to be on title to both the sale and the purchase at the same time. You have to be on title to only one of the properties. And so in order for us to do that, we actually have to park one of those properties in a corporation temporarily. So the reasons I bring this up is because from a financing perspective is if we're going to park the acquisition property, that property has to either be bought in cash or a hard money loan because no traditional lender is going to loan on a property we are taking title to. So that is just something to think about. If they are getting traditional financing, we will have to park their sale property on the other side. So that's why we just want to bring up what are the options for each client. It's definitely going to vary. All of our institutional investors or institutional clients that have millions of square feet, those people will all do reverse exchanges because they will not take the risk of the delayed exchange.
For sure. That makes a lot of sense.
Plus, our fee is larger for reverse exchange, but for the institutional people, still not enough for them to blink their eyes.
Yeah.
So, next, we have the simultaneous exchange. So, a brief history lesson. Pre-1984, all 1031 exchanges were simultaneous. So basically that means you had to sell and purchase in the same day. So obviously that can be very challenging. And fortunately for us, TJ Starker challenged the IRS in tax court and he won. And so now we have delayed exchanges and a little more time to make things happen. But the simultaneous exchange is great. I want to give one example where this could be a really good program for you. So basically we had a client, he had a business partner. They owned two properties. They each owned 50% of each property, tenants in common. And basically one of them wanted to sell and the other one didn't. And so what we did was a simultaneous exchange between the investors, 50%, 50%. It might have been off a little bit just because the values of the properties were different, but essentially it was 50% ownership swapping to each other. And then basically one client was able to do a 1031 exchange with his 100% ownership of one property. And the other gentleman was happy because he got to keep his property that he was happy with. So simultaneous exchange is still useful more from a strategy perspective than a typical 1031 exchange scenario. Last but not least, we have the build-to-suit construction exchange. So if you have an investor who might want to improve the replacement property, this would be the program for them. So I'll give you an example. Say you sell for $1 million and you find the perfect replacement property for $700,000, but you have $300,000 left of cash. Basically, you could use that $300,000 to make improvements on the replacement property. So that could be a new roof, a new kitchen. You could add on a unit. You could put a granny flat in the back. You could basically make capital improvements with that cash. So the way this works is we will park title to this replacement property in a corporation, and we will pay all of the contractors to us. So basically, we act as the bank, we pay the contractors, and all of those improvements must be permanently affixed by the 180th day. So from a timeline perspective, basically, 180 days can go by very quickly, especially when you're doing construction. So you need to get permits approved and be reasonable with those improvements. A ground up build up may not be possible due to the 6-month program it takes to get a permit in California. So in other states, much easier to do a full build up. We have several clients doing build to suit ground up construction in Texas, but that's because they had improvements, permits already lined up, basically. Perfect. So frequently asked questions. What is boot? Any cash proceeds remaining after the acquisition of the replacement property is taxable at the appropriate capital gain rate. So what this means is if your clients sell for $1 million and they find something for $900,000 and they had a little extra cash left over, they would only pay tax on that amount of cash. It wouldn't void the 1031. All they do is pay a little bit of extra taxes. Can my investor acquire a replacement property out of state? So yes, your investors can purchase property anywhere in the continental United States or Hawaii, or actually even our US territories. However, the California Clawback provision states they must file Form 3840 at the end of every year. This is because the government does not say goodbye to tax money. They will track that tax money until you eventually sell. So if you defer out of California into Arizona, and then you defer out of Arizona into Oregon, California will still be tracking that property in Oregon. So basically, that you will owe those back taxes from the date you sold here, and it will be prorated, of course. So some other states have the same provisions, and some of them don't. So it just depends on which state you're coming out of.
Of course, California does.
Yeah, of course. They were the first people to institute it.
I would imagine.
They will chase this money until they die. So just be aware that that money is deferred and not tax-free. Okay, when may an investor access exchange funds? Number one, the investor has purchased all the replacement property identified. So once an investor has purchased all the property, we can return any cash left over because you've purchased all the property identified. Two, if you have an investor who is not going to have a successful exchange, they can't find a property, we do not want them throwing a Hail Mary on that list on the 44th day, because we will have to hold that money until the 180th day, because they will view that property identified as, hey, maybe there's still a chance they could purchase one of these properties, even if it was just purchased by another investor. So unfortunately, that would not work. And then third, three, once the 180th day exchange period is ended, we will return any funds. So those are the three options for getting your money back. If your clients know in advance they want some of the money from the sale of their investment property to go to their bank account to pay taxes on, just let us know and we will wire that money. We'll direct escrow to send that money separate from the exchange funds to your clients. Perfect. So what are the non-recurring closing costs that can be deducted from exchange funds? Basically, this is a list of all of the fees that can be deducted.
Oh,
So,
you know what? I'm sorry, Adam, to interrupt you, but we do have one question. What happens when the 45 days ends and nothing is purchased?
right. So if the 45-day ends, nothing is purchased, we will return the funds to the client on the 46th day.
Got it.
They will have to pay taxes.
Did I answer your question, Alejandro? Awesome.
Correct. So what non-recurring closing costs can be deducted from exchange funds? Basically, title insurance, notaries, brokerage, your fees, tax advisor fees, any transfer taxes that might apply, city or county, attorney fees, inspection fees. This list is essentially what can be deducted to lower your taxable liability. So on $1 million sale, maybe you have $60,000 of closing costs or more, and essentially you only have to buy a property that's $940,000 in value. So that's why I bring this up, because this will lower the qualifying replacement property value. So contractual conditions of sale, that's on there because if the buyer says, hey, I'm not going to buy this property until you fix the roof, and if your client has to come out of pocket to fix that roof, and as long as it's in the contract, it will lower their taxable liability. So obviously it works just like a write-off would. So I just want to make sure people know that it's a contractual condition of sale, not a verbal, hey, please fix the roof.
Just got it. Yeah.
IRS isn't good at that.
I don't think so.
Perfect. So partnerships. So please let us know if any of your clients have a partnership. General partnerships, for instance, are going to be held as stock in a corporation. So if you have 4 investors in this general partnership, basically those 4 each own a 25% interest in stock in the partnership. So why I bring that up is because that's not technically real property. Real property would be either a tenants in common, a single member LLC, or some sort of individual owner, not a corporation owning this asset within the corporation. So it's really important that we know in advance if that's the situation. I want to give one example. We had a client, I came from commercial real estate. I worked for Lincoln Property Company up there in Irvine, but one of our clients was selling a $13 million industrial building in San Clemente. And what happened was this property was held as a general partnership, but we were told they thought there was 3 partners, but essentially there were only 2 partners. One of the partners wanted to leave and do something else with his funds, and one of the partners wanted to do a 1031 exchange. The reason this was problematic was when it came down to the wire and this property sells, that three people person ownership will retain a partnership ownership. Once one person leaves, you have to have at least 2 people there for this to be a partnership. So once one person left, there was 2 people, it automatically dissolved the corporation, therefore making it ineligible for a 1031 exchange. This is because the general partnership, and you could do a 1031 exchange with the partnership as long as you keep partnership intact. But once that partnership was dissolved, you can no longer do a 1031 exchange. So it's really important that we know in advance if there is anybody that wants to liquidate, anybody that wants to be bought out, because there are several different strategies by which you might be able to accomplish this. And it's really important that we know far enough in advance so that we can restructure anything that needs to be restructured. For a lot of people, if the general partnership, if most of the people want to get cashed out eventually, we will actually dissolve the partnership into a tenants in common interest, so that once the property sells, probably a couple of years later, then that person can take their percentage ownership and do a 1031 exchange, while the rest of the people will pay taxes.
Sure.
So just let us know. We're here to basically consult on any deals. We don't charge anything for any consultations. We have attorneys in-house, so we have legal counsel. They're happy to look over trust documents, corporate documents, anything that might help you have a better grasp on the transaction. And we'll do all that free of charge just to make sure your clients are on par for a good, successful transaction, because we have a lot of these transactions that we are already working on that aren't going to happen for 2, 3, 4 years. So we're always happy to consult on those far in advance.
Well, that's great. And then one little question I've got is,
Yeah.
I'm sure you have some kind of resource that you can distribute to us that'll help us answer a few of the questions. However, of course, you'll be available to our agents when they have questions about 1031 exchanges.
Of course.
Awesome.
I'm located in San Diego County, so I handle anything. San Diego County, Inland Empire, I'll even go to Arizona. But we do have different people for Orange County. Debbie Bannister, she's very good. She handles our Orange County territory. And then we have Phil Atwan in LA. So if anyone's in LA, he handles the LA County territory. Both of them have been with our company for over 20 years. So lots of experience.
Okay, excellent. One of our agents, Alejandro, is saying that, you know what, he's got a client right now that needs his help. So there you go, Adam. So Alejandro, I'll coordinate a conference call with you guys after the webinar.
Perfect. So last but not least, we have what if my client passes away during an exchange? The estate would be permitted to acquire the replacement property. So if it's in the middle of a 1031 exchange, we have had some gentlemen that were very old and they were trying to get this completed before they could be done, but unfortunately they passed away, and so the estate was able to finish the transaction. I will give one example. So one of the reasons why some of our older clients are doing a 1031 exchange is because as part of an estate planning goal, they want to leave the property in more of a liquid asset. And so the only liquid asset that's really you're able to hand down that's not technically an individual property would be called an UPREIT. And I want to briefly go over this transaction. It's basically it's stock in a real estate investment trust, but what they do is they actually drop a property out of the trust into a real property or organizational structure like a TIC, and then you can actually exchange into that property. It will sit there out of the REIT for 2 years, and then it will be absorbed into the REIT and converted into shares. And so this is one of the very few stock transactions that's technically blessed by the IRS.
Right. Very interesting.
Nothing else is. And last but not least, do vacation homes qualify? I get this one a lot, especially because I handle the Palm Springs region. So basically, these are the criteria that must be met. 1, please establish a long-term investment hold. So 24 months of ownership. They want to make sure you're not flipping these homes and running Airbnb in the meantime. So property has been owned for at least 24 months. 2, the property was rented at fair market rates for at least 15 days of each of the previous 2 years. So for 15 days of each year, just have your clients pop that sucker on VRBO or Airbnb and get it rented. 3, it was not used for personal use in excess of 14 days or 10% of the time it was rented. So if you rent it for 300 days out of the year, you could use it for 30 days. But really, how they prove this, I will defer that to your CPA.
Absolutely, right?
That is the revenue procedure to refer as far as the law is concerned.
Yes, of course.
Perfect. So that kind of brings me to the end of my presentation. We do have a DST presentation that's separate and not run by me, but if somebody has any interest in that, I can send you some hard copy material on that. But basically, we're here as a resource for you guys. And if you have any questions or concerns, my phone number is always open. And we do have offices up and down the coast. So if anybody wants to come in and host a client here, we're also happy to do that. My boss wants to show off our new live edge wood table. So
I love that.
Always welcome to our office. Thank you all for tuning in. I really appreciate it. And if you have any other questions, now would be a time to ask.
Yeah, absolutely. And also, guys, just know that when I put the replay of this video out, I'll have all of Adam's information there. I'm going to put Adam's phone number into the chat just in case you guys need this, and I'm sure you will. And then, make sure to just, get him into your database and, use him as a resource. As he said, he's there for you guys. So we will be distributing some kind of, information about 1031 exchanges from Adam, but there are a lot of ins and outs to this, so definitely give him a call. And I go ahead.
I have one question.
Yes, Travis.
Well, maybe two. So, question I get occasionally from clients is, they're selling a rental property and, how little equity, what's the minimum you would suggest as far as what they're going to be netting from the sale to even bother with a 1031 exchange to defer it?
That's a good
Right.
question.
So basically, this is pretty open-ended, but a lot of times I just refer to their CPA and I say, hey, look at your tax liability. It could be, our fee is only $750 for one sale and one purchase. So for a lot of people, that's not a whole lot of money as far as, what, um, I mean, we had a client that was only going to save like $4,000, but he did it because he didn't want to pay $4,000 for the
Okay.
government. And so it's really going to depend on your clients. For some people, it might make sense for them to just pay the tax and move on. But I would definitely defer to their CPA for the hard numbers from that, for sure.
Okay.
That makes sense. And
Can
then,
everyone see this property analysis spreadsheet, or do I need to click on a different button?
you may need to,
Yeah, I don't see it.
if you have two screens, you may need to drag it over to where your Canva presentation is.
Okay, let me see.
There you go. Now we can see it.
Can you see it?
Yep.
Yeah.
Perfect. So this is a spreadsheet I created with back when I was doing brokerage. Basically, it helps calculate some of the investment property statistics and financials. And I know that sometimes when you're showing your clients here, what are the actual operating expenses? You put them in down here, and then you can put in your monthly income, sale price, closing costs, and you can kind of figure out exactly how this asset's going to perform. If anybody would like the spreadsheet, just let me know, or I can send it to Kevin and he can distribute it.
Oh,
But it's
great. No, this is a great spreadsheet.
it's
Yeah.
very useful for showing clients, here's my cap rate, here's my NOI, here's my cash on cash return.
Big
Oh,
time.
look, my cash on cash return sucks and I need to do a 1031. So for some
Exactly.
people, it can be very helpful, but it just depends. I'm a numbers guy, so and I know a lot of investors, they appreciate seeing the numbers. So if this is
Yeah.
something that can be of use.
Oh yeah. I mean, when the numbers are staring you straight back in the face, it makes it easy to make decisions, doesn't it?
Exactly.
Awesome. We do have one more question. What are the alternatives to 1031 exchanges?
Right. So an alternative to a 1031 exchange, and I'll give this example as far as you mean replacement properties. Is that what you mean? Like what you
I believe that's what Alejandro is asking.
Right. So we do have something called the Delaware Statutory Trust. Essentially, a company such as Inland Securities will go out and they'll buy a property for $200 million. They will put a loan on this property for $100 million, and then they will sell interest in this property to 1031 exchange clients. So basically, your client comes out with $1 million, they can go buy into this property as a percentage ownership and receive rents basically off of this property. So an example of a DST would be ESPN's headquarters. Their office is a DST. That's an Inland Securities product. It
Interesting.
could be the multifamily product across from NASA's headquarters. That's also a DST. It could be, there's really a lot of options. I mean, there's a DST for almost every kind of, there's storage, self-storage DSTs, there's student housing DSTs, there's single family home DSTs. So there's a whole lot of options. But yeah, I think you just do your due diligence on those sponsors, look at their track record, make sure they survived 2008. That would be key, and see how they handle a downturn. Because a lot of these companies, especially like Inland Securities or Pasco, they actually never dropped below an 80% occupancy rate. So they did very well. And so it really depends on the product type. And of course, multifamily would be considered safer. You obviously wouldn't want to own a portfolio of Toys R Us's or something like that. But you can see how this is a very popular alternative right now. The rep for Southern California, Charles Jensen, when I first started working with him several years ago, he was only bringing in like 20 or 30 million dollars of exchange money into this product type. And this last year, I think he did 400 million.
Oh
So
wow.
a huge increase, especially as baby boomers are retiring. They just want the cash flow without paying the taxes. And so this is how they can get that, basically.
Unreal. Let's see. I don't see any other questions. Any other questions from you, Travis?
Nope, because my second question was, what's the fee? And he answered that. So,
That was my
Oh,
that was my
yeah,
question too. No, thank you so much, Adam. We really appreciate you coming on our Wednesday webinar and
yeah,
informing our
great info.
agents.
no,
Yeah,
thank you, Kevin, and thank you, Travis. I appreciate the opportunity.
absolutely. And every once in a while we like to have our guest speakers come back, and so we'd love to have you come back in another couple months and keep us abreast of anything's changing. Maybe after the first of the year, and just keep reminding us, of what we need to know as agents.
Perfect. You got it. Thank you so much for having me. I appreciate it.
Heck yeah. All right, agents, get out there, make it a productive week, make it a great week, and we'll see you next week on the webinar.